The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to today's webinar entitled Revenue Sharing Complicates Fee Disclosure. I'm Neil Pline, Director of Sales at Invest and Retire, and I'm joined today by Lou Harvey, CEO and President of Dalbar. Dalbar is recognized and respected in the financial services community for its credibility, independence, and contributions in raising the level of excellence in the industry. Fiercely committed to delivering value to customers, Lou Harvey has proven through Dalbar that the business principle of putting the customer first does work. In the spring of 2010, Lou Harvey was named the president of the Foundation for Fiduciary Studies, an organization dedicated to maintaining fiduciary standards and communicating the inherent value of fiduciary relationships to the public at large. Lou has held governance positions at a number of institutions, including the National Association of Security Dealers, Federal Reserve Bank, Bentley College, and Plymouth Plantation. Now, Lou, I think everyone would agree that there has been quite a bit of confusion surrounding fee disclosure, specifically what will require disclosure, how, and when. It's as though an area which is already inherently complicated has become even more confusing due to the evolving nature of the regulatory language. So what exactly does a plan sponsor have to disclose to participants under the new fee disclosure regulation 404A5?
I couldn't agree with you. Well, I should say good afternoon. I couldn't agree with you more on the complexity, the complications of this, and I particularly thank the Department of Labor to introduce three different disclosure-related regulations, essentially at the same time, and having all three uncoordinated. So it is certainly understandable that folks are confused about this. But to answer your very specific question, there are really three types of new disclosures that are required for participants. Plan sponsors are required to disclose to participants plan-related information. That's sort of the first broad category. And this is a fairly straightforward kind of disclosure that has to be made prior to participants making investments and then annually thereafter. This includes things like how to invest, what are the administrative expenses associated with investing. They're also required to disclose the list of available designated investments in the plan. Mm-hmm. The second category is perhaps one that has more complications associated with it, and that is the individual participant's actual costs. Plan sponsors are required, and probably through their record keeper, they're required to disclose to participants what actual administrative costs were every quarter, mm-hmm, allocated to the individual. And that would include both an allocation of plan-related costs and the costs that were incurred directly by the individual participant. So the second category is the actual costs. The third are the investment-related costs. And this is a little bit different from what most plans do today, in that there's a heavy emphasis on expenses in that, and the fact that it must be presented in a comparative format. So the investment-related disclosures have to include returns, expenses, restrictions on any of those particular investments. And as with the plan-related disclosures, these investment-related disclosures need to be presented to participants before they make an investment decision and annually thereafter. So it's a little bit like an enrollment kit kind of disclosure with some additional requirements. I would hasten to add, however, that plan sponsors remain obligated to disclose any known material facts, regardless of whether it's required by the new regulations. One of the things that I've heard very often occurring is, All we have to do is comply with these regulations on the 404A5, and just raising the issue that you cannot ignore other regulations that exist out there. One of which is 404C, and others are the fiduciary responsibilities of plan sponsors to disclose material facts to participants. So, all that being said, there's a long answer to your short question.
So Lou, if a plan sponsor is unsure if he or she needs information from, say, the mutual fund company, what steps should the plan sponsor take in order to determine if they're missing information?
Well, I think there's a method of doing it that is sanctioned by the Department of Labor. Because one of the things I think the Department of Labor recognizes is that these regulations are new and the industry is not yet fully aware of what's going on. So I would expect some degree of tolerance on the part of the regulators as this thing goes forward. Mm-hmm. The specific steps, you've got to find out what it is that you should know. In other words, what are the things that you need to know from the various service providers that you have, both for purposes of reporting to the participants, as we discussed before, and also under the obligation that plan sponsors have to determine that costs are reasonable for their plan, which is a really central focus. Mm-hmm. So the first step is to find out what you should know. There's a couple of ways of doing that. One would be to read through the regulations, sort them out, and figure out which applies to your particular plan. That's the hard way, and not exactly a highly reliable way. Yeah. Most of us don't really read through these regulatory details in any, with ease. Sure. But I'd mentioned to you before that we've put together a paper that summarizes some of this stuff. That's a useful place to find, what it is that you need to know. Okay. So, go ahead. Yeah. Now, so I suppose that would cover the mutual fund company and the service provider. But if the plan sponsor determines that fee information is missing, what should be done to obtain that information? There has been introduced an entire new mechanism, a really large-scale, important mechanism that I think plan sponsors need to understand. In the event that a plan sponsor feels that the information they have is incomplete, inaccurate, or, for that matter, not usable the way it's presented, they are obliged to go back to the to the service provider and ask them to correct the situation. Okay. Service providers have 90 days to do that, after which time they are required to report that to the Department of Labor and get an exemption. Okay. So if the plan sponsor requests fee information from a service provider, but the provider fails to provide the information, what type of penalty, if any, does the Department of Labor impose on a service provider? Well, the Department of Labor itself actually doesn't impose it. The way it works is the Department of Labor would refer that failing service provider to the IRS. And the reason for that is that the Department of Labor doesn't have specific jurisdiction over the service provider, but the IRS does. The IRS has jurisdiction over all of us. Mm-hmm. And through the IRS, there are some sanctions that are imposed, including fines and penalties, excise taxes, and the IRS could actually disqualify that service provider from providing additional services. The IRS can also require the service provider to disgorge themselves of any compensation they had already received. So it becomes potentially a very painful exercise not to comply. Okay. Now, on the plan sponsor side,
what type of penalty, if any, does the Department of Labor impose on the plan sponsor if the DOL determines that the plan sponsor has failed to obtain the necessary fee information in order to comply with 404A5?
Well, that's the 400-pound gorilla that's sitting in the room.
Mm-hmm.
The Department of Labor has simply said in the disclosure that failure to comply is a fiduciary breach.
Right.
And for those of us who've been involved in the fiduciary world, we know the litany of issues that brings to the table. You know, direct sanctions from the Department of Labor, the same set of IRS issues that we talked about on the service provider side, also opening themselves up for litigation. So it becomes incumbent on the plan sponsor to make sure that they, in fact, report and report to participants in complying on 404A5 and receiving the appropriate information on the 408B2, the reporting that comes from the service providers.
Okay. Now, you mentioned a little bit before about an exemption. Can you discuss how the exemption works?
Sure. We just talked about the penalties associated with the fiduciary breach.
Mm-hmm.
What the exemption does is it says we're going to waive all of those penalties. We're going to insulate you from liability in the fiduciary breach if you properly report the failure to us. So the exemption is to exempt them from complying with the regulation and avoiding a fiduciary breach. So the Department of Labor says we're not going to prosecute you, and in fact we'll defend you if somebody else comes after you for failing to comply with the 404A5.
Okay.
Or the 408B2. So the failure is exempted from prosecution under those exemptions. And there are some rules for, you know, how you get the exemptions and the like.
Okay. So now, talking about the plan sponsor getting this information, how does the plan sponsor determine if the fee information he or she receives from a service provider is complete and accurate?
That within the set of regulations, I mentioned that there are several regulations, and within that set of regulations, there's a number of checks and balances that a plan sponsor can and should use to validate that the information that they get is reasonably accurate.
Mm-hmm.
They're not held to a standard of precise accuracy. The standard is reasonable accuracy. And reasonableness, in our view, means that, you know, the plan sponsor has taken the basic steps to see that the data is right. Do the reports balance? Are the providers listed in one report complying by reporting the, you know, by delivering the appropriate reports? Does the core data, the number of participants, the assets, the total fees across these various reports, do they all agree? And the three reports I'm talking about, I don't remember if I mentioned them before, but the three reports I'm talking about that should link together are Schedule C for those plans who report on Form 5500. They are the 408B2 fee disclosure from each of the covered service providers, and the 404A5, which the plan sponsor is obligated to deliver to the participants. So those three have common data. They basically have fee and expense information, and clearly, if they disagree, it's pretty evident that at least one of them are wrong.
Sure.